Hello and welcome back to our PWM Tea Break series here at the FT Studios in London. I've been away for 2 weeks, but it's good to be back alongside my co-host Yuri. Joining us this week is Christopher Rossbach. Chris is a managing partner and chief investment officer at London-based J. Stern & Co., a private investment partnership specializing in global investments for high net worth individuals, families and institutions. Chris, great to have you on the show. As you know, it's a show where we drink our cup of tea and discuss, all these pertinent topics. What tea have you got today?
Well, I decided to go for English breakfast tea. First of all, because it's almost 25 years since I moved to London. Okay. And secondly, because it's budget day. So I think it's the right choice.
I mean, I went for the same as well. English breakfast tea is UK budget day. So it only makes sense. Yuri, what have you gone for?
Well, I hate to break with the consensus, but I've gone for the ginger tea today. And I'll tell you why. Because this emerged in China maybe 5,000 years ago. And one of our main features this week in PWM has been about emerging markets, where we have a great debate between two rival portfolio managers. I think we've got Sami Suzuki, a great name for the motorcycle lovers, from Alliance Bernstein, claims that emerging markets are lands of opportunities. And we've got a rival portfolio manager, Arthur Budagian, from BCA Research, and he believes emerging markets produce only challenges these days, not opportunities for wealth managers and their clients. Chris, if we look at the two main developing markets, and incidentally the two main producers of ginger tea, China and India, which one would you back with a long-term bet?
I have to say I read the articles and I think they were excellent. And they have some very good points. I think they actually are both right because they both hit on very important points. I think both China and India are very large economies that are very dynamic. China has started earlier in terms of its development and in bringing hundreds of millions of people out of poverty, establishing a consumer economy that is very large. And so we think that there are companies doing business there that offer great opportunities. India is further behind. It is developing very rapidly, in particular the infrastructure spending, but also the consumer economy that they're building is growing very rapidly. And so we see opportunities in each. We invest in companies, not markets. And so for us, it's always about finding the right companies to invest in, and then the opportunities that those companies have to generate value.
And I think India is celebrating Diwali this week, which cues all the fireworks every night in West London, where Ali and I live. It's quite a noisy, celebratory environment at the moment. And of course, one of the main determinants, Chris, of emerging markets, they're often very closely correlated to the dollar. And one of the main factors they're looking at is the forthcoming US election, which we're all looking at. And my colleague Elisa wrote a very nice feature this week about the different economic programs of Donald Trump and Kamala Harris. And many investors seem to be favoring a Trump presidency due to the perception of lower taxes and regulation. But yet the prospect of the massive Trump tariffs on Chinese and other imports could be very damaging for the US economy. We've been getting some questions from the readers sent in, and one of them, a very provocative one from Simon Hopkins, chairman of East West Private Wealth, a wealth manager in Singapore. I haven't seen him for a few years. I remember doing a few interviews with him in the past. He's claiming the current US administration has presided over what he calls the worst acceleration in national debt in recent history, record levels of illegal immigration, large transfer of wealth away from working people to the owners of the largest companies in the US. And he also believes US diplomacy has been conspicuous by its absence. His question is, why should anyone consider voting for the Democrats, and why is the election so closely run? A very provocative, slanted question. What are your views on those claims?
Well, I think there's a lot of claims in there in that argument, and I think some of them are valid, but also contradictory. So I think the fact that there has been strong economic growth in the United States is very clear. I think the U.S. has overcome some tremendous challenges, and I think we have to take a long-term perspective. It's about the global financial crisis. It's about the pandemic that was overcome through government spending. And it's then about the inflation that has taken place as a result, I think, in part because we've not had inflation for so long, and in part because of the bottlenecks, both in terms of the supply chain and in terms of people going to work. We shut down the service economy in the U.S. During the pandemic. That's 70% of the U.S. economy. So the fact that we're having this big dislocations, I think, is something that had to be expected. And we're now at the point where we're coming out of that, but where people are voting based on their past experience. And if you see what people are saying when they're saying they're voting for Trump, it's because of the economy. You can't argue with the economy pre-pandemic. And I think the point is you can't argue with the economy pre-pandemic, but the fact is the U.S. is coming out of it. It's growing. Inflation is moderating. Employment continues to be strong.
Very good jobs figures, aren't they?
Very good jobs figures that we've had. It's been surprising for people how strong the economy is. It's not been surprising for us because we look at what companies are doing, and those are doing very well. So I think there's a lot of reasons to vote for the Democrats if you believe in the policies that they stand for. I think there's reasons to vote for Donald Trump if that's what you see. But I certainly think that the U.S. does well when there's a form of gridlock. And when there is a consensus-based and decision-making, and when, therefore, you end up with an economy that does well. Because I think one of the things about Goldilocks is that in the fairy tale, it's always just right, but in reality, it's always too hot or too cold.
And hopefully our tea isn't too hot or too cold from the FT canteen. They've got the Goldilocks formula up there. Yeah. And Ali, if I can throw it over to you, because we've had another question, a brilliant question's come in from Malik Sawar, former very senior banker at Citi, and that relates to the US economy and to the Magnificent Seven stocks whatsoever. What has Malik been asking?
Yeah, so Malik Sawar, who's now running, the Global Leader Group in New York, with non-state actors, increasingly having more influence than governments on our economies, like Elon Musk, he's teaming up with Donald Trump, as you've seen in the past few weeks. He asks, what effect will this trend have on wealth creation and investment opportunities, particularly in areas like AI or the Mag 7 stocks or tech as well?
Well, I think the U.S. has a 100-year track record of generating value through big companies, private initiative, innovating, creating value, creating jobs, and creating growth. And I don't see any reason to believe that will change. There's always periods where there is somewhat of a concentration, that there's disruption, and we're at a moment where, in particular, the big tech platforms are very large. There's also always been influence from companies and from individuals in terms of politics. So I think we're seeing with Elon Musk something that is at the extreme end of it. But the fact is that the U.S. institutions have held. They're set up to be robust. The U.S. is a very federal country where many things, the power of the presidency is constrained. It's actually largely much of what the presidency can do is around foreign policy, which is why tariffs is such a big part of what Trump is talking about. So I think the outcome will likely be a lot more moderate and balanced than what is being said at election time. And I think as long-term investors, that's what we look for. And I think if you're thinking about how to preserve and increase the value of assets over time, then it's very important to take that kind of long-term view and not to be overly influenced by what is being said around election times.
And of course, the other major story is more of a post-election story here in the UK, Chris. I was driving through West London with my younger son yesterday evening, and there was huge traffic congestion, and Acton High Street, it was just chocker, not moving at all. So I said to him, look, have a look there. What's going on on the left? And he said to me, the left. He said, they're in power at the moment, Dad, and they're about to announce a budget tomorrow. So a good joke I quite enjoyed from the youngster. And I haven't seen as much focus on a budget, on a UK budget, I think for probably a couple of decades as the one tomorrow. And in Keir Starmer's speech earlier this week, I think he mentioned the word investment 16 times. And Rachel Reeves' budget is likely to include a focus on infrastructure investment and boosting that great national treasure, the National Health Service in the UK. Chris, I wanted to ask you, do you remember any UK budget having such prominent build-up in the past? And do you think this government is capable of restoring faith in UK PLC for both foreign and domestic investors?
Well, I started out by saying that I'm having the tea in recognition of 25 years here in the UK. It's where I live, it's where my family is, it's where we have our business, and we're very committed to the UK and to London as a place. I think it is a very important budget. I think there have been very influential governments over the times, and big changes, when big policy changes have been put in place. But I do think after the period of government that the UK has had, after the lack of investment, I think, in public and private infrastructure, after the austerity that has meant that there's been significantly less investment in services, including in the national health, but in other areas, after the privatization that has led to very significant issues, in part because of the structure, in part because of the oversight, which we've seen in terms of the water, which we've seen in terms of the national grid. I think there's been a long period in which a government has been in power, and the elections were a sign that it was time for something else. And I think that something is investment, so I think it's absolutely right, and that's why it is such an important budget. I think the question is, so far we've heard a lot about the problems, and about, in particular, the fiscal hole that exists as a result of where the economy is. But investment, you cannot have growth without investment, but investment is something optimistic. It's something forward-looking. It requires leadership. It requires the expectation of generating returns. And what we see in the U.S., I was with my family in the U.S. driving from Denver to Phoenix through the national parks.
A bit more glamorous than driving through Acton, I think.
I'm a West Londoner myself, and I get the joke. If we look over to the left or right, it's mostly construction, but that's not all bad, because that's infrastructure. And as you're saying, driving in the U.S., you practically couldn't drive over a bridge or walk by, across a highway without a big sign saying this is being restored or invested in because of the Bipartisan Infrastructure Act. And so that is this Inflation Reduction Act. It's the investment in infrastructure that the U.S. government is doing. And I think it is high time that there is that kind of investment here in the U.K. There's a lot of infrastructure that can be invested in. It will generate positive returns for the economy and for people, and for some of the companies we invest in, like, for example, Eaton, the world's largest power management company, Xylem, the world's largest water management company. These are going to be major contributors to the investments that, for example, the water companies or the national grid are going to make in the infrastructure, and it's going to come with opportunity, with jobs, with incomes, and with growth. So I'm very optimistic and hopeful for what we're about to hear.
And of course, now with the world we live in, where the wealthy families are very mobile, they can move to other centres that are investing in infrastructure, where they can co-invest with other families there. And Ali, you've been writing about different financial centres, about Geneva and Zurich as well, and I think you've been to Zurich recently. Chris, these rival wealth hubs and financial centres which are all competing. You wrote a nice piece, Ali, about Geneva's well-known family-owned banks, one of which is Bank Sitz, launched by Eric Sitz in 1996. He was a refugee from Lombard Odier, from a very traditional bank. They very much rebranded themselves as they look to transfer power and ownership from one generation to the next. Will this be a successful move, Ali, you think, the rebranding of Bank Sitz and other similar mid-tier banks?
Well, Bank Sitz it's known for that relationship it has with art. I mean, if you go to their offices, It's decorated with all these art pieces. And, recently it rebranded, highlighting a push by Swiss, I guess, boutique mid-sized private banks, to stand out amid, industry consolidation. And their campaign was titled "Welcome to Switzerland," and and included new hires like Felipe Turan, who now joins Nicholas Sitz as co-head of wealth management.
So they're very much keeping it in the family.
Indeed.
Nicholas and Mark Sitz running the private equity.
Yeah, indeed. And they say this emphasizes its commitment to growth and client centricity. And, industry experts on one hand view this as a shift, as a potential response to, I guess, the rising, dominance of these large private banks and asset managers. But on the other hand, some say, hey, this is just very cyclical marketing. It's nothing. We don't need to really make a big deal out of it. And it's just mere marketing. But I think with SITS, it's that blend of tradition and agility. It really sets it apart from the other Swiss boutique banks at the moment.
They are very different. They've always ploughed their own furrow. And Chris, I wanted to bring you in because you work for a family-backed firm with a strong presence in Zurich as well in Switzerland. Does family backing or ownership or links with a major family, does that give an advantage to both investors and those running the business over the large quoted banks, the likes of UBS, JP Morgan and Citi, those investment machines?
Well, so J. Stern & Co. Was founded by my co-founding business partner, Jerome Stern, and myself to be backed by the Stern family and to manage money for investors on a long-term basis. The Stern family itself is one of the great European banking families from Frankfurt. Absolutely. With a 200-year history. But I think the key aspect of it is really twofold. One, it's about the alignment. So we're a partnership, and it's very important that we have a partnership in terms of the ownership of the business, the assets that we manage. So of the $2 billion we manage, 20% come from the Stern family and from ourselves. The partnership with the team, and then also the partnership for all of those whom we manage money for. So I think when there is, in French, there's a saying, le patron mange ici. The owner of the restaurant eats here. And so if you eat your own cooking, the alignment is very important. And I think the second aspect that's also implicit in what you said is about the long-term approach. Because if you are an independent business, if you're backed by a family that has a long-term record in terms of what it's doing, you can take a long-term approach. And I think it links into some of the things we're saying. With all the volatility that we've had, if you take a long-term approach and you believe, have some principles, you believe in them, you invest accordingly, you can do very well over time. You can go through these things. And a family like the Stern family with a 200-year tradition, and there's other families, of course, that have great histories and have generated great value, they stand for this long-term approach and prevailing over time. And I think that is good for people who invest money with them as well.
Well, not only are we eating our own cooking, we're also drinking our own tea from the canteen upstairs. And my favourite ginger tea has been used to treat many ailments over the years, although I'm not sure yet whether it can help us deal with a potential Trump presidency or a disputed election or the prospect of more wealthy families leaving the UK, and we're seeing a bit of an exodus at the moment. But we'll be debating many of these issues and questions at our FT Global Wealth Management Summit next week. Ali, you're going to be chairing several panels there on Wednesday and Thursday, 6th and 7th, I think, of November at the Landmark Hotel. Any topics that you want to share with our viewers?
Yeah, well, that's right. Next week is the Global Wealth Management Summit, which is FT Live and PWM's flagship gathering of private banks, family offices, and wealth managers, discussing the most effective investment strategies and opportunities for product development to capture a shifting client base. We just have a handful of tickets left. So if you want to secure your place at the summit, please visit the FT Live website. I will be chairing two panels, as you just said, one on India's public versus private markets, kind of understanding the disconnect, and another on, moving beyond the Magnificent Seven, seeking exposure to AI outside those big mega stocks. So if you have any questions, please don't hesitate to send them through. That's all we have time for today on our PWM Tea Break series. A massive thank you to Chris for joining us today. And from me, Yuri, and the PWM team, it's goodbye.